Hello friends, on behalf of Banking Quest, I Tilagulati extend you warm welcome. Friends, now we will be having session 3 on our discussion on anti-money laundering and know your customer. Friends, if you have not gone through our previous videos, session 1 and session 2 on the topic anti-money laundering and know your customer, my request to you that first you go through those videos. Unless you go through those videos, you will not be able to fully appreciate the content of this video. Friends, in our session 1 and session 2, we had seen the definition of money laundering. We had also discussed the various methods of generating illegal funds. We had also seen the income tax rules, how the income of a person earning dirty money out of illegal means is treated by income tax department. And we had also started our discussion on methodologies of money laundering, which a money launderer adopts to convert his dirty money into clean money. We had already discussed the methodology of structuring of transactions and methodology of cash smuggling, cash intensive business, trade based laundering, shell companies, round trapping, bank capture, casinos. And in this session, we shall be discussing the methodologies of real estate, how through the process of real estate, dirty money gets converted into clean money. We all know that in all real estate transactions, there is some part of black money, some part of white money. So in all real estate transactions, some part of dirty money gets absorbed. This is how dirty money gets converted into clean money. But some banks are deliberately or undeliberately converting dirty money into clean money through the process of real estate. Giving an example, supposing a person buys a property of 10 lakh rupees on paper. He gives this property as collateral security to the bank for availing credit facilities. So, but bank is not accepting the value of that property as 10 lakh rupees, which is on paper. Bank is asking its approved valuer to give the market value of that property. Supposing the approved valuer gives the market value of that property as 1 crore rupee, in that case, bank should have understood that property on paper is of 10 lakh rupees, but the market value is 1 crore rupees. It means the person who has bought this property has given 90 lakh rupees as dirty money. But bank is accepting the market value of 1 crore rupees. Against this, bank is giving a loan of 80 lakh rupees to the borrower. So in other words, we can say by accepting a property as security which is purchased out of dirty money, bank is giving clean money in the shape of loan to the borrower. I shall give you another example, real case example. In one of the branch, in one of the bank, a borrower was enjoying a working capital facility of 20 crore against the security of mortgage of 10 properties to the value of 40 crore. He was enjoying these credit facilities for the last 30 years. There was no default in the account. There was no overdue in the account. And bank was very happy that bank was earning interest income, bank was earning non-interest income. And at the same time, bank was having the security almost double of the amount of the value of credit facilities enjoyed by the borrower. But all those 10 properties to the value of 40 crore, supposing there are 10 properties to the value of 40 crore, one property must be just equal to just around 10 crore rupees. All those properties were given by the borrower, which were in the name of his servants, in the name of his maid, in the driver, in the guard, in the car cleaner account. So all these properties were in the name of his servants. So when he was giving those securities and bank was accepting those securities, bank should have applied its mind. Whether a driver or a guard or a maid can purchase a property of 4 crore rupees. But bank was accepting those securities and giving loan to the borrower. What had happened? Borrower was earning dirty money out of illegal means And with this dirty money, he could not have deposited this amount in his bank account. At the same time, he could not have purchased the properties in his own name. So he was purchasing those properties in the name of his servants and giving those properties as securities for availing loan from the bank. So in other words, we can say bank was accepting properties purchased out of dirty money and giving loan to the borrower in the shape of clean money. This is how the bank was being befooled by the borrower for the last 30 years. So, friends, whenever as a banker, you are accepting any collateral security in the shape of property, please always ensure that that property was purchased by the mortgager through his clean money and not by his dirty money. So friends, these are the general methodologies which a money launderer generally adopts to convert his dirty money into clean money. Structuring of transactions, cash smuggling, cash intensive business, trade-based laundering, shell companies, round trapping, bank capture, casinos, and real estate. These are the general methodologies a money launderer adopts. But what is the mechanism a money launderer adopts to convert his dirty money into clean money? This is the general mechanism. This is the general scheme. This is the typical scheme a money launderer adopts to convert his dirty money into clean money. Under this scheme, he adopts 3 steps. These are placement, layering, and integration. In the first step, he will place this money, he will deposit this money into the banking system. Taking again the example of the doctor, he has deposited 45,000 rupees each in 10 accounts. So through this, he has placed 4,50,000 rupees into the banking system. Once he has placed 4,50,000 rupees into the banking system, then he will transfer from one account to another account, another account to another account, another account to another account, through mobile banking, through internet banking, through NEFT, through check, through draft. So he will put a lot of layers that it will seem that all those money is coming from one account to another account through the banking channel. So he was, by putting so much layers, the original source of deposit of cash is somewhere lost. This step is called layering. Once he has put a lot of layers on the original source of deposit of cash, then he will ask his son, his daughter, his wife, his servants to transfer those money in his own bank account. And with this money, he will purchase a house, a car, a luxury item, or he will go for a foreign trip. Supposing he purchases a house, a car, a luxury item, through this process, the dirty money gets integrated into the economy. Once the dirty money gets integrated into the economy, then if the doctor sells his house, he will show it to the income tax department that he has sold that house out of this much amount. This is his clean money. So, through the process of placement, layering, and integration, the dirty money gets converted into clean money. This is the typical money laundering scheme which a money launderer adopts to convert his dirty money into clean money. So, friends, if money laundering is going on through our banking system, why we bankers are so much concerned that money laundering should not take place through our banking system? What is the risk to the bank? Banks are not producing anything. Banks are not manufacturing anything. Banks are providing simply services. And banks are able to provide services because banks enjoy a trust on the general public. If the trust of banking system is lost, people will not keep their deposits into the banking system. So, to maintain the trust, banks will have to keep their reputation intact. Supposing trust is lost, the reputation of the bank is also lost. So this money laundering, suppose money laundering takes place through a bank, it carries a lot of reputational risk to the bank. and the risk is legal risk. Suppose money laundering takes place through one bank, so that lot of legal cases will come up against that bank. If there are so many legal cases against the bank, it hampers, it jeopardizes the reputation of the bank. And third risk is operational risk. If money laundering takes place through a particular bank, then the regulator, Reserve Bank of India, can put fine on that bank. And Reserve Bank will put fine on the bank because of failure of internal processes of the bank. Maybe people processes, maybe system processes, maybe technological processes. So, if supposing Reserve Bank puts a fine of 2 crore rupees on ICICI Bank, 2 crore for ICICI Bank is a very small amount, but it carries a lot of reputational risk to the bank. So all these risks, reputational risk, legal risk, operational risk, these are not independent risks. That one risk will be there and the risk will not be there. No. All these risks are interrelated and together have the potential of causing serious threat to the survival of the bank. We have seen the example of Yes Bank. We have seen the example of PMC Bank. We have seen the example of Lakshmi Commercial Bank. So due to loss of their reputation, even their survival had also come on the risk. Warren Buffett, the largest investor in the world, he has said, it takes 20 years to build a reputation and 5 minutes to ruin it. If you think about that, you will do things differently. It may take 20 years to build the reputation of the bank, but it will take only 5 minutes to ruin it. So to protect the reputation of the bank, we bankers have to do things slightly differently. The bankers need not do very big acts. Only small acts are sufficient by the bankers to protect the reputation of the banks. And those small acts are complying with Know Your Customer guidelines. So friends, we will be discussing about Know Your Customer guidelines in our upcoming video session 4 on the topic anti-money laundering and Know Your Customer. So friends, my request to all of you, please register on our website bankingquest.com. This website has been made exclusively for bankers. In this website, you will find a lot of blogs and tutorials which are very much relevant to the bankers for their day-to-day operations and also very helpful in their promotional examinations. So friends, Banking Quest is conducting webinars and workshops on banking. If you want to attend our periodical webinars, please send your email address and telephone number on our email info@bankingquest.com. We will send you the invitation link. Please note, attending our webinars and workshop is totally free. So friends, my request to all of you, please like this video. Please also subscribe to our channel and also share this video with your friends and your banker colleague. Thank you very much.